Good afternoon and welcome to Kolibri Global Energy's year-end results and reserve update. Kolibri had a fantastic year drilling 5 wells into the Caney Formation, utilizing their new completion technique, which resulted in proven reserve adds increasing by 43% and surpassing their exit forecast production number of 2,700 BOEs a day, and coming in at 4,000 BOEs, over 4,000 BOEs a day. With us today from the company is Wolf Regener, CEO, and Gary Johnson, CFO, to discuss their year-end results and 2023 forecast. Kolibri trades on the TSX under the ticker symbol KEI and on the OTC under the ticker symbol KGEIF. If you have any questions, please enter them in the Q&A box. As always, the presentation will contain forward-looking statements. Wolf and Gary, do you want to hit on any of the highlights initially of your reserve report and the quarter and the year? And then we can go into some questions.
Yep, that'll be great. That'll be great. Yeah, well, as you said, not planning on going through the whole presentation or anything. I'm sure that most people that are on the call have seen us before. And there's some other webinars out there that kind of goes through everything, but we'll kind of hit the highlights of what's new, etc. Go through forward-looking information, keep our attorneys happy on the disclaimers, the non-GAAP measures that we're reporting in adjusted EBITDA, etc. Everyone, I think, knows who we are, so I'll skip through these slides as well. And I'll let Gary kick off with our 2022 financial results.
All right, thanks, Wolf. Thanks everyone for joining us. So we're just going to go through some of the 2002 financial results compared to last year and also to the forecast we put out last year as well. So adjusted EBITDA was just over 25 million, which was an increase of about 282% from the prior year. And also exceeded our forecast that we put out of 23 to 25 million. Net revenue was 37 million, which was an increase of 150% from the prior year, which also exceeded our forecast of 35 to 37 million. The average production was 1640, which was right in the middle of our forecast and was an increase of 68% from the prior year. And then we had published this already, but our exit rate at the end of the year was over 4,000 barrels, which was far exceeded our forecast of 2,700. The net debt was 16.8, which was right in the range of our forecast as well, of 15 to 17. And lastly, our leverage ratio, our ratio of debt to adjusted EBITDA was 0.83, which was below our estimate, our forecast of 1. And then we also have the 23 forecast that we put out in the earnings release, which we're going to go over later in the slides. And then back to Wolf.
All right, that's good. So just the one thing I want to touch on this, I think everyone knows this, we had a large ratio of, PDP versus PUD reserves. We were at about 10% last year, and so we moved that up to about 18% this year, just with those 5 wells. So we're making steps in the right direction, unlocking value as we go forward and converting that to cash. And our reserve split is about the same. We have about 11% PDP, but 50% in PUDs, and we have about 39% in probables going forward. I'm not going to touch on this too much. There's our production split, as Gary put out already, our adjusted EBITDA of 25 million versus the 6.6 million from the year before. Production fourth quarter, about 1,800, almost just under 1,900 BOE a day. And then the big thing was our proved reserves, how much they'd increased this year. Our NPVs went from about 360 million up to 550 million. On the proved side of things, our proved and probable, 724 million. And our 3P is actually just under 940 million. So big numbers considering our market cap is about 160 million going forward, or as it is right now. Those are all US dollars, obviously. And everything we're saying today are US dollars unless we actually indicate otherwise, just because the property is obviously in Oklahoma. Gary, you want to touch on the forecast here?
Yeah, sure. So as we said, we put out this forecast last night in our earnings release. So we're projecting annual production of between 36 and 4,000 barrels with an exit rate between 4,500 and 5,000 at the end of the year. Our CapEx, we're estimating between 44 and 51. And this is a forecast, just is between 6 and 7 wells, depending on some of the environment and just the well results that come in on the first few wells. The adjusted EBITDA range we're having is 52 to 55. We continue to have our leverage ratio below 1, and continue to hold our debt steady at between 16 and 18. And I won't go into the other ones, but yeah. So basically, we're projecting a good amount of increase from 22 results, as you can see.
Yeah, thanks, Gary. And as Gary said, this is 6 to 7 wells. We're looking to adjust that later on this year, depending on how things go, depending where oil prices are. Obviously, they're down a little bit today, or actually, or come back up again today. I should say in the last week or so. They're down a little bit below where we're using the $75 oil price assumption. So all those things together with, I'll get into decline curves a little bit and what's changed from last year to this year on the next couple of slides. But putting all those things together, we wanted to have something that's conservative. We want to be able to hit our targets, and there's still, a lot of unknowns with pricing as far as where oil's going, what's going on in the world in general. And so that's why we have the targets that we have, and hopefully we can drill more wells and cash flow, and the board will approve it. But we'll be recommending more wells, assuming that our cash flow shows that. We'll also have our bank redetermination that's coming up here. So we'll see what that gives us for availability as well. On the difference between last year and this year a little bit, we've got last year's curve going into 2022 prior to us drilling any wells in 2022 was the PUD East curve. That was the dark green line here that you can see, hopefully see my mouse as well. The light blue was our corridor curve that we had put together, which was also just the average of these wells, just with a lateral length normalized to a 1 mile lateral. Netherland, Sewell this year did give us credit for having the higher initial production rates. And there's 2 different curves here that I'll get into a little bit on the next slide as far as why. But they've got their normal PUD curve, and then they have a risk curve, which is only slightly different, but it makes a big difference on the ultimate EURs. And that's, like I said, what I'll get into on the next slide. Still making some great returns on internal rates of return. We're using 7.2 million as a well cost going forward. And one thing you'll note here is that they gave us a higher IP, but then if you get out here to month, let's call it 12-ish, you can see that they actually dropped these curves down below what they were estimating last year on these curves in order to make up for it. So our hope is that we actually hold in higher than this, and thus the EURs will come up further. These are this red line here is the average of our 5 wells that we drilled last year. And obviously we don't have full production for all these months for all 5 wells. So what we do is just take the average for those months we have, and then put in just the remaining wells for what the average is for the rest of the time period here. So you'll see this curve changing over the year as we get more data, but we're holding in well above what they have assumed on the type curves here so far. Here on the PUD side of things, every year we've been increasing the EURs on the PUDs. 2022 was no exception on most of the PUD locations. It went from 555,000 BOE up to 572,000 BOEs. And then, as I mentioned, this risk curve here. So what they did was in the sections that we drilled wells, and the section is a square mile, they have added in the amount of oil we produced from our original well was there, and the well that we produced last year, and what they expect that well to do. So since those wells did so well, they're expecting those wells to take a larger share of the volume that they've accepted in this reservoir for that square mile that they've given us credit for in the past. And said, okay, there's this much remaining for the other wells in this section. And that's where they came up with the 485,000. Now, the one thing is they bumped us up in the sections that don't have wells, but they didn't bump us up in the sections as a whole in that volume space for those sections in there. That's just what their choice was. They did obviously increase our proved and our probable and possibles in those sections as well. And so we do have more reserves that we can get out eventually out here, assuming these wells perform well. We just need more production history. So once we get more production history, these wells hold in higher than what their curves are here. As we drill these wells this year, then you'll see that number come up again. But Netherland, Sewell is one of the best reserve engineers around, most respected, I should say. So they're in the top 3, and sometimes they're just, well, they are conservative, and sometimes they're more conservative than I would like. So that's kind of the difference between these two. You'll also see on our reserve report overall, our BOE number stayed about the same, but our barrel of oil number in the proved category, and I'm just talking about the proved category there, did go up about 2%. And that was also because they gave us more credit on the amount of oil we're being produced. So on a proved basis, they're estimating that we're going to produce about 75% oil versus last year was about 72%. So that haircut the gas a little bit, but it increased the oil, and that's good for us because economics are for us here is based on oil because that's most of what we produce. That's really the biggest difference between last year and this year. They gave us credit for a few locations down here that moved into the probable category from the possible category because of these wells here, and then these moved into the proved category. We don't have 100% in these interests here in these sections. We have about anywhere from a 25 to a 50% interest. So we didn't get as much of a move on the proved reserves as you would have expected if we had 100% of this section here. Everything else is pretty much the same. We still have 180 booked well locations because of the extra 5 locations that were moved into the proved category. And 17,000 acres really hasn't changed, still 98% held by production. Still have all the gathering system obviously in place. And we're looking forward to drilling wells this year. So what we did announce on the drilling of the wells, we're going to drill 2 more Caney wells right now and a T-zone. That's our first 3 wells that we're going to put together. Excuse me. So what we're going to do is we're going to fill in a pad here of a 6 well per acre spacing or per section spacing for the Caney. And then we're also adding a T-zone well, and we'll add that right below the Caney. So the T-zone is a formation that is technically the Caney. We've broken it up in between the T-zone and the Caney because we've seen a difference and we've seen a bit of a frac barrier in between here. And we had drilled some early wells into it that was very understimulated. So we put in about 2,000 pounds per foot of proppant in our wells now. And back then, the first well, we only had about 1/3 of the lateral in the T-zone. We also had 1/3 in the Sycamore and 1/3 in the Caney when we were trying to figure out which zone we should complete. The second well in the T-zone had about 300 pounds per foot, as I recall, and the second one had about 600 pounds per foot. Our best well in the T-zone had about 1,000 pounds per foot of proppant, again, with our old completion technique as well, using a lot of linear and cross-link gels. And it came on for 750 or so BOE a day, but it declined pretty hard. So we are looking to see, with our new fracture stimulation technique, if we can get higher IPs would be great, but less of a drop off. We want more of a decline that's similar to what the Caney wells are, and hopefully we can make economic wells that are similar in economics to the Caney. So that's our idea for this. The reason for that is, as you can see, the T-zone extends over the entire acreage block that we have, or virtually the entire acreage block. And so with that, we have a lot of upside potential in reserves that aren't in the reserve report. We can make good wells here, then we have a lot of locations that can be added to the reserve report. What that number will end up being, will leave to be seen. We wouldn't be drilling 8 wells per section here, but even if we add 2 or 3 wells per section, in even 200-acre spacing, would make a big difference to our reserve report and our economics and how many wells we can drill in the future here for the running room that we have. We put together another slide that shows just an illustrative development, much like we did last year. We'd put one out there early in 2022 and an arbitrary number of 3,000 BOE a day. And so we put another one together for an arbitrary roughly 4,000 BOE a day, saying what would it take in order to have that happen. Last year we used a $90 oil price because we put that originally out when oil was 110 to 120. This year we're using a $75 oil price. Well costs, we bumped them a little bit above even what we think we can do them for, 7.4 million just to be conservative. And it says, or it assumes 6 wells per section, or 6 wells, excuse me, in 2023. 2 wells in 2024 and 3 wells in 2025. So at $75 oil, assuming Netherlands Sewell's type curve with the tail being a little bit higher, because I believe we're going to keep production up a little bit above that on our cases here, on our proved developed cases. That's the assumption that we used, generates this kind of CapEx or this kind of EBITDA in the $50 to $60 million US range, holding it around 4,000 BOE a day. Takes the CapEx in 2023 a little higher, obviously almost 49 million. But after that, it takes a CapEx of, call it 22 or 20 roughly million, which generates a lot of free cash flow, even at 4,000 BOE a day. So depending on how these wells do, we will hopefully outperform this. And likely the board will also approve us drilling more than 2 wells out here, and hopefully we can do more than 6 wells in 2023, and let's get better. But it just gives everyone an idea of, even at $75 oil, how much cash we could generate from this property, assuming all these caveats. And then it's up to the board as well, and our recommendations as far as what we do with that cash as it goes forward, whether it's dividends or returns to shareholders. Whether we pay off our debt or keep the debt the same, around 18 million or so, just to go forward and see where this company goes. But I'm excited. Love what we're doing. Love the fact we've drilled some really great wells last year. And we've got a lot of running room, 60 proved locations, not even including the T-zone, which gives us another update or another up leg potentially. We've got a lot of running room, and we can increase what we're doing and have a lot of value for shareholders out here. And with that, that's it. Happy to take questions.
On your reserves, you only had pretty limited data on the last 3 wells that you drilled last year. Had you, let's say, 6 months of data or 9 months of data on those wells, do you think you could have, what do you think your PDP number could have increased by? Do you have any idea?
Oh, I don't. Yeah, I didn't run that, and I'm not going to venture a guess. I think it'd be higher than that, because if you look at it, our wells, assuming that the wells do like our average wells did last year, from my composite curve, it's obviously far higher than what Netherlands Sewell has given us credit for on the PUD case of things. So I think that they probably put the declines up higher on the PDP wells. I haven't had a chance to compare what they are on the bigger wells and how hard they hit us. But my guess is that they declined them pretty hard, and that'll hopefully change as we get more production, and would have been a little different once we get more production. But putting a number on it is just tough.
Had you not answered almost all of my questions, I wouldn't have asked you that one. At any rate, so you're trading at such a huge discount to your proven NAV. So what is the what do you think that it's going to take? Like, do you think this year of drilling will close that gap, or what do you think the market needs to see to get you at a normalized discount?
Yeah, I think we should be able to, if we can make good wells and we can see, cash flow coming in, wells performing well through this drilling program that we put together, especially if the T-zone adds as well, that should give enough excitement, I think, in the market in order to have us close that gap more. The more cash flow, the more it is. And what I've been telling people too is, look, people that started believing in us, before we drilled the first couple wells, took the most risk, right? We drilled 2 wells, have 9 months of production. You can see that it's doing well. It reduces the risk in the property, and we drilled 5 now, where I'm really comfortable with what we're doing in the middle of the field. Other people are too, and some people like waiting. So some people that don't want to pay for it up are waiting till we get more wells drilled. It's hard to know where that number is, but it's just the nature of the business. The more wells you drill, the more you de-risk things in people's minds. As much as I think we're quite de-risked as it is right now.
Yeah, very much so. And I just don't think you're getting as much credit as you should be for what you've accomplished.
Yeah. And I think also the oil price drop here has scared some people in general, right? So there's a lot of uncertainty in the industry that we need to have that settle down for people to feel more comfortable to allocate.
Yeah, there's definitely a risk off going on, that's for sure. And it is impacting the oil price, what's happening with the banks. On the T-zone, as you said, you've drilled wells into it already, and if this well is successful, how do you see that changing your drilling program for the well that you're drilling on this 3-well pad right now? How do you see that changing your drilling program going forward?
I think that assuming this well works well, then I can see us drilling patterns like this with, drilling our Caney wells and then drilling 1 or 2 T wells, right, or T-zone wells right below it. And that makes the most sense to fracture stimulate them all at the same time. So you're not going to have any interference. As much as we think there's a frac barrier there, and we've seen that demonstrated, you wouldn't want to take any extra risk. You'd probably want to develop that at the same time.
Okay. And what's the biggest difference between the quality of reservoir?
Reservoir looks good. It's a little bit higher on the gas side of things, and we need some more wells with our new completion to see really what that split is. But they had a little bit more gas contact in the past. But otherwise, it's a good looking reservoir. It's a little bit more fractured. So it had a little higher deliverability, and we saw that off the bat. That's why we drilled the first few wells into it. So we just didn't like the declines associated with it, but we think the new completion technique that we're using, our latest generation of that, can take care of that. So we don't, we put the fracture stimulation where it needs to be, which is around the wellbore.
Do you have a slide of your current hedges right now? And do you expect that, given your increase in reserves, that the bank will require you to hedge less?
That is what we are going to try to do. We are going to see if we can negotiate lower hedging, and that's roughly where our hedges are. I think that's up to date. I didn't check that today, so bear with me if that's not completely accurate, but it's pretty close. What our hedges are right now. And so, yeah, as we go forward, one of the things we want to do for our line increases, then we don't want to have to hedge 75% of our production, which is what it was right now. I think that should be reasonable, especially how much production we've added this last year.
What was your production mix in January, oils, NGLs, and natural gas? And do you expect this ratio to hold through 2023?
I don't have it off the top of my head, but it should be roughly in that range where we've been.
Yeah, I think we're in the mid 70s, and I don't think we expect it to go maybe down a couple percentages from that during the year, but
yeah,
it'll hold around there. 70%, 75% oil.
7% of
wells
those.
coming on, and we still have some other wells that are coming that were lower on the oil side of things. So that was back on a couple slides here. I think I have that here. There's our production mix. So it was about 74%.
When isn't it more profitable? I mean, this person's speaking to your base case kind of scenario where you pay back money to shareholders instead of drilling, and he's saying, I think that's what he's going after. Isn't it more profitable to shareholders to drill more wells in 24 and 25 than give cash back to shareholders?
To be clear, this is just to show how much, this slide is just to show how much cash can be generated by the property. It's definitely not, if you look through this, it's not based on any budget or capital expenditure approved by the board or any plan per se for the board. This is just as an example to show how much cash can be generated if we just held it at 4,000 BOE a day. The odds of us doing exactly this are quite small. So we'll decide what's going on when we get to those levels. Right now, we've approved 6 to 7 wells for the year. That will hopefully change as well. Hopefully we can increase that. And then going forward as well, we'll decide, what we think is the best value for the shareholders. Is it going to be drilling more wells? Probably. I just can't say that at this point in time. And we're not building a case out that shows every drop of oil coming out of the ground, going back into the ground here for drilling new wells. So like I said, this is just an example to give a demonstration of how much this property could generate, even if we just hold it at 4,000 BOE a day.
Yeah, it's just an illustrated.
Yes,
and then
exactly. what
kind of corporate decline rate would you be comfortable with? Because you don't want to get on that treadmill either. So,
we'll know a lot more as we get more production coming on. So, and we have the tails of what the wells from last year. So, it's hard to predict that until you know exactly what these wells are doing. And that's one of the reasons for us being conservative as well. We want to see what the decline rate is on everything to make sure it holds in where we think it's going to be. Hopefully we're being conservative about it, but we won't know for sure until some more time goes on. The wells look great. Everything is going along really well. Let's make sure that, so, you know, we don't want to get the company in trouble. Others, you know, in the past have done that in certain areas. Won't mention names, but, you know, drilling too fast and not knowing the spacing and doing those kind of things and just going ahead blindly is not good for the long-term life of a company. So we
No,
have to do it
not
prudently.
typically, not
And
typically.
it's frustrating for some people that we're not ramping up further than that, but you know, I and the board believes that this is the right way to go to build shareholder value.
Yeah, and like I said, you never want to get on that treadmill because, and then if you have like, you know, oil coming down like it is, or, you know, that kind of thing, you've got to slow down your drilling, and the next thing you know, you never get back on to where you were, right? Which we've seen happen in the Permian. We've, you know, seen happen with multiple companies throughout the years.
Trust me, I would love to have a single well drilling program going, or a single rig drilling program. Constantly
Yeah.
makes life easier.
Yeah,
So
for sure.
that is a goal. That is definitely a goal, but we want to do it prudently.
Now, your 4,500 to 5,000 BOE a day exit number seems pretty conservative, considered you kind of exited it above 4,000 already. Are you just leaving yourself? I'm assuming you're leaving yourself room for.
Yeah, exactly like I just mentioned. But you know, we want to make sure we know what these declines look like. You know, we're haircutting what the average well is that we had made last year as well for a development program here. And hopefully they come in just like they did last year and that average, and they hold up really well. And then we'll be through that. But likewise, we probably won't wait to the end of the year if that's the case in order to change our forecast. So as things change, we'll change the forecast. And hopefully we can get more aggressive. But at this point, I think it's prudent for us to go about it the way we're going about it. And our board agrees.
Given the volatility in oil right now, I have two questions surrounding that. At what price would you start to cut back your drilling program?
Well, right now, that's a hard question to say. We'll have to run some numbers, but we make good money even down to $60, $65 oil on these wells. Okay. So I think that, you know, at least 6 wells would probably happen unless oil seriously drops off in the 50s. Okay. We'd really have to take a look, but I think it makes sense even if oil is trading at 60, 65, because we also believe that it's not going to stay there.
Yeah, so, you know, fundamentally, I don't think it should be there myself, but yeah, right. Who knows if it goes.
If it drops to 50 tomorrow and it's still there in 3 months, then obviously we're going to revisit things, and we're a small company, so we can adjust quickly. But yeah, for the foreseeable future, hopefully we don't have something like that. You'll have price swings up and down. You can't panic over them. You just have to keep going in a prudent fashion. And like I said, we try to put things together in a conservative fashion. So even if oil drops a little bit, it's okay. We can make it through it. We're not risking the company or anything. So, and that's the main goal.
And then because of the volatility in oil price, you said there were some acquisitions in your area that were of interest. Have you seen prices come down at all on anything you'd like to buy, or are you still not really looking given the valuation you're trading at?
Yeah, we haven't made contact with those things that we haven't a target on ourselves. So because the price isn't there, and we don't want to take on a huge amount of debt. So at this point, we're a little bit being patient. We're doing some work on some of the things so we can hit that when we're ready. But right now, we're just looking to do what we need to do here.
So back to the bank. Given a significant increase in PDP reserves, what do you think the bank line could increase to?
Again, so things have changed a lot in the last few years. I used to be able to use a rule of thumb back, you know, anywhere from 4 or 5 years ago to 15 years ago. That's kind of out the window right now. And we'll see what the banks do. So it's a little up in the air. I think there's room for them to increase our line, but I can't guess at what that's going to be. So they have their own metrics inside. It's always a bit of a black box.
Yeah, it's hard to know. They're not like they used to be, where it was fairly predictable. And would you consider a buyback as opposed with the significant free cash that you can generate, or would you stick to more just to increasing your drilling program?
I think for the near term, I think we should increase the drilling program a bit more, but that doesn't mean that there shouldn't be something that's allocated to a buyback or a dividend. But again, that's something that we or Gary and I and the board will meet on when that happens. So we can set a longer term goal for that maybe later on this year, as far as defining what we do in the future. But right now we don't have a decision one way or another on that. It's all been discussed, but when the time is right, then we'll take a look at it. Right now, we want to get these wells drilled on cash flow and hopefully drill a few more wells would be my recommendation. And
the 3-well pad program you're doing right now, when should that be completed? And you can you can start selling product from that?
Depending on the timing of the frac crew coming in, hopefully they come in right as soon as we're done drilling. So we're looking at, hopefully, I'll say 2.5 months, roughly.
Okay. So we should probably, and then when does so then do you have a rig planned coming for July?
We do have another rig coming later on this year, yeah. Hopefully around July.
Okay. And then just okay. Yeah, okay. I'm just making sure I'm getting all these answered here. Sorry.
No worries.
And then what else did I have? Okay, I think we you did a good job getting the story out in 2022. What additional plans do you have in 2023 to get in front of more investors? Well, I can answer that. I mean, we've got lots. We've got lots of marketing plans, etc. Right now, with the volatility in the world, it's it creates opportunity, I think. Given what the macro situation truly is on oil, so I think it makes sense to actually get out and see people when during this period, but until everyone's calmed down a little bit too, the risk off is definitely going to hinder, I think, some people taking on new positions, but it's not going to last forever. So but we have multiple things planned as far as conferences and road shows, so we should start seeing some new investors, etc. And then my last question, what's your biggest concern or risk in this environment?
We're looking pretty good. So I don't have anything that's really concerning me, just normal oil and gas. You want to make sure we execute well, that, you get good equipment, good crews. And I think we have those things going forward. And then if we execute well, hopefully we'll make really good wells and we'll be able to increase what we're making and thus what we do, and grow the asset value further and faster than what we're kind of projecting. So right now, oil prices will go up and down. Hopefully nothing drastic happens. I think there's more risk to upside prices than downside prices, other than short term. And hopefully that comes true too. So I've been in this business a very long time. So, oil prices do go up and down, and you kind of try to take care of those kind of things so that your company makes it through it. And my companies have always made it through downturns. So yeah, I'm good.
Well, and knowing you as long as I have, and that's probably one of the reasons why you're being conservative on your numbers. You know that things can happen that are out of your control. So better to revise up than go the other way. So
absolutely, yeah. If we're revising down, then there's big things that have happened.
Yeah, exactly.
So that's at least that's our goal.
Yeah. Have I missed anything, do you think?
I don't think so. Not for me. And you had some good questions that came in, which is great. And like I said, we're all excited. We want to drill some good wells here, and looking forward to continuing the success that we had in 2022. So
Yeah,
that's about it.
congratulations,
So-
and you're doing a great job. So thank you very much, and keep you apprised of if anyone has any additional questions, feel free to email me, jessica@adcap.ca, or if you'd like a meeting with the company directly. But other than that, thank you very much, gentlemen, and have a good afternoon.
Yeah, thanks everyone for their time.